Hey folks, welcome to a product review at Finominal. Today we're going to analyze the 5 largest low volatility ETFs trading in the US stock market. Now, most of these simply select stocks that are less volatile than the stock market. And most investors think of low volatility strategies as diversifying, defensive, protecting capital. So let's explore that. And we're going to kick off with a portfolio analysis. So this is a holdings-based factor exposure analysis where we effectively look at the portfolios of those 5 ETFs compared to the S&P 500. Now we can see different fundamental metrics: market capitalization, growth, momentum, volatility, and also quality. And if you look at portfolios from a volatility perspective, we do see that 4 of those ETFs have portfolios comprised of stocks that are less volatile than that of the S&P 500. Having said that, one of them, which is ONEV, that has a portfolio that is not less volatile than the S&P 500. And we can explain that by effectively selecting stocks that are Russell 1000, which includes large caps and mid caps. And it seems these were more volatile, which then simply the S&P 500, right? Therefore, you see no differentiation here. From a growth perspective and also quality perspective, all these 5 ETFs are very similar to themselves as well as the S&P 500, so there's not a lot of differentiation here. We can complement this by running a returns-based factor exposure analysis where we use the last 8 years in terms of returns. And we do see that the primary driver of risk and returns was the S&P 500. We do see, of course, the positive betas to the low volatility factor. And you can also see that the magnitude differed in certain cases. Perhaps most surprising is that we do see that negative beta to the quality factor. And for a lot of investors, low volatility is a subset of quality or complementary or substitute. But that's actually a misconception. These factors are not correlated, as you can see over here. And if you have exposure to quality stocks in your portfolio and you add a low volatility product, then you might net off your quality exposure. So that's something to think about. The other part, what's worth remembering, is that these are smart beta ETFs, which means, yes, the factor contributes some risk to the return over time, but majority, this is equity risk, right? Because it's a long only portfolio, not a long short portfolio. Now, if we actually talk about risk, right, we can actually look at the performance during stock market crashes. And what we see over here is somewhat a discrepancy in terms of how these 5 ETFs performed during sell-offs and crashes. Some of them did better, some of them did worse. There's no consistency here. That's one point. Also, what's worth mentioning is that in some crisis periods, low volatility ETFs generated a lower drawdown than stock market, but not consistently. So, for example, during COVID, the S&P 500 fell by 18%. Having said that, only 2 of these ETFs fell less than that. 3 of them fell more, and ONEV, which does, as mentioned, have a bit of exposure to mid-caps, fell a lot more. So that's something, remembering that low volatility ETFs do not necessarily always provide lower drawdowns than the market. Now, if you compare the performance of these 5 ETFs, we do see that one of them, which is the product from Fidelity, kind of consistently generated a higher return since 2016. And this is not only from a return perspective, but also from risk and return perspective. So here we see a simple risk and return chart, and we can see this product from Fidelity. It had the highest CAGR, while featuring a relatively low volatility, which effectively means, right, that from a risk return perspective, that's on the higher side. And if we do look at the Sharpe ratio, we can actually confirm that the product from Fidelity featured the highest Sharpe ratio over the last 8 years. From a fee perspective, we can see all of those ETFs are fairly cheap. The fees are ranging from, the most expensive one is 25 basis points. The cheapest one is the one from Spider, LGLV, with 12 basis points, but this is kind of like almost marginal from a cost perspective. And so the kind of like one final point is, right, if you think about that product from Fidelity offering the highest CAGR as well as the highest Sharpe ratio, right, that you might think, hey, this is kind of like, like the instrument to go with, right? But it's more interesting to think about what explains that. And we can explain the better performance of FDLO by its exposure to the tech sector. So here you see effectively the exposure breakdown by sectors, and you can see that FDLO has a fairly high exposure to technology stocks, which is kind of unusual because technology stocks typically are not low volatile, they tend to be more volatile, right, than the average. And so that of course also explains why FDL performed that great, simply because the last, since 2016, right, tech stocks overall outperformed the general market. And so that's something to remember, right, in the sense of that, sure, like outperformance is great, right, but it might come at a risk, right, even if that risk hasn't crystallized yet. And so this kind of concludes our analysis of these 5 low volatility ETFs. As you can see from a performance perspective, right, one clearly outperformed, but we can explain that by its exposure to the technology sector. We can look at them from a fundamental perspective and see that they are all quite similar, except perhaps the one that provides exposure to mid caps. And so there's not a lot of differentiation. There is not a large difference from like a cost perspective. They're all fairly cheap, which of course makes it somewhat difficult to choose one of them. But hopefully in parts of what we've highlighted over here in terms of some of the minor differences, right, are helpful to you in your decision process. And yeah, I hope that helps. Have a nice day.